The overwhelming majority, over 75% of postgraduate taught course students are self-financing. The government assumed that students will self-finance through a system of professional and career development loans. What we found is this PCDL system, as it's known, is basically fundamentally flawed. The problem is that the sort of characteristics which banks take into account, looking at whether somebody's got career history, earnings, maybe whether they've got a house, what's their credit record like, aren't really suitable when making loans to people who are newly qualified and newly leaving university. They frequently won't have a career history, they won't have a credit history, they won't necessarily have a job at the moment. In fact, they're taking out a course precisely so they can get a better job. And therefore you have a situation where the people who need these the most often find that they're inaccessible. When you know about these students, they're actually a very good credit risk because they're likely to get higher earnings as a result of their qualifications and therefore being able to pay back their loans. On the bank's standard lending criteria, they're not. And the result is a relatively high interest rate, which puts off the students who need it and often makes these completely inaccessible to the students who need it, but perversely means that the government, who's meeting the interest rates, meeting the interest payments for the first year, that public funding, about £15 million a year, is actually very frequently being channeled to people who don't need it. Some financial websites say if you don't need one of these loans, take it out, bank the money, the government will pay your interest and you can take the savings interest at the end of the first year.